welcome back. We're here on chapter 4 and we're going to continue on with where we left off from the end of chapter 3. The end of chapter 3, we had been working through the accounting cycle and working through adjusting journal entries. So let's pick up here and kind of do a little bit of a recap so we can see where in the big picture we are. So I've got a few things already written out here. Just remember we were talking about the accounting cycle. And I said within the accounting cycle, we basically go through 3 mini cycles. And each of these mini cycles are started off with a trigger. So what we learned in chapter 2 was that the first thing that we do is whenever business transactions come across our accounting desk, we analyze them to see whether or not they are accounting type transactions, or if there's some other sort of business transaction that doesn't get recorded by accounting, like hiring a new CEO or winning an account. Then the next thing, the next thing we have is once we have a business transaction, we're going to record it as a journal entry. And this looks at it from the transaction point of view. So as an example, let's say we had a loan. This is a business activity. We say that is a business transaction, so we record it on a transaction level as a debit to cash and a credit to note payable. And then after we have a whole bunch of these journal entries, we start breaking them apart and posting them. And this looks at it from the account point of view. In other words, not at the individual transaction, but looking at all the different transactions that had cash as part of a transaction. So we would have a cash T account, we'd have a note payable T account, and whatever else we had. At the end, we'd have a whole bunch of cash entries, and we don't want to put all those cash entries in. We just want to put the summary of the cash entries into our trial balance. And so the trial balance would have, okay, there might be a bunch of entries, but we are going to line them up as saying, okay, here is the summary of the cash T account, here's the summary of the note payable T account, and all the different T accounts that we have. And that was the first cycle through. Then the next mini cycle that we go through is, well, what is the trigger? It's the end of the period, end of the accounting period. So let's say it's the end of the year. And whether it's end of the year or the end of the month, but whatever the end of the accounting period. And what we end up doing is, instead of looking at journal entries, we're looking at adjusting journal entries. And these are still transactions, but they're not quite as visible. For example, let's say we prepaid our rent at some time in the past. Well, at the end of the year or the end of the month, we need to do some sort of transaction that shows we're going to use up part of this prepay. So here, an adjusting journal entry, because time has passed, that's what triggers the adjusting journal entry. Time has passed, and we're going to look at the end of the period, is we would debit rent expense and we would credit our prepaid rent. And similarly, this looks at it at a transaction level, but we would also have an account level. And so we would post it to the account, to the ledger. And so there would be a T account called prepaid rent, and we would have pluses and minuses in it. And then we would again take the previous trial balance. We would take the previous entries that we had put in there, the cash and the note payable in this account, and we would just add the additional entries for the adjusting journal entries, in this case the prepaid and the expense, and I'll just put one of them down here. And that left us with the adjusting trial balance. That brought us to the mini cycle number 3. And what was the trigger here? Was that we were going to go ahead and do the financial statements. We were going to use the adjusted trial balance to create the financial statements. And then after the financial statements, we would have closing journal entries. We would post those as well. And we would have a closing trial balance. And once we had gone through that, we would be ready for the next year, or for the next accounting period, the next month. Ready for the next period. So what we are going to do in chapter 4 is we're going to learn how to go from the adjusting trial balance to the financial statements, which is what we're doing in this lesson. And then the next video will be these last 3 items: the closing journal entry, the post, and the trial balance, and then getting ready for the next period. So between the adjusting trial balance and the financial statements, we have something called a worksheet. It compiles all the information and makes it a little bit more little easier, more visible for us to figure out what we're going to do. So on the way from the adjusting trial balance to the financial statements, let's take a look at this worksheet and see how it helps us. Okay, so here is what we have as a worksheet. So let me describe the different parts that we have going on. You notice right here, we've got the trial balance, and you can see all of these items are regular transaction, cash, supplies, prepaid, insurance, equipment, all these things we buy. But you notice they're not the individual transaction. Again, these are the summary items, and they're in their proper columns, debits and credits. And you notice that the debits and the credits all equal. Down here in yellow, we have all of these adjusting journal entries. And you can see they're typically fewer, and that we actually track them individually. So the supplies expense, you notice this has an A here and an A here. So what we can track is that someone went in and counted the supplies on hand. We've had a couple of homework items that we've looked at, and someone said, okay, we used up a certain amount of supplies. So what do we have? We have a supplies expense, and we have a reduction of the supplies that takes it from our original count minus 1,500, leaves us with a balance of 1,000 in the supplies. So we used up 1,500 in the supplies. Here is an insurance expense. Now you can see the B is 50 debit. And where is it being taken from? It's being taken from our prepaid insurance. So this is another thing that we've done quite often. We have a prepaid and we're using up 1 month of it. And we can go through all these different items, but you'll recognize them as being adjusting journal entries. Here's the accumulated depreciation. And if you look at it, it's a credit to accumulated depreciation, and it's a debit to the depreciation expense. Here's an accounts receivable. We're recording some service revenue for which we have not been paid yet. Remember, that's an accrued revenue. So I guess I should say this is a prepaid expense. This is a prepaid expense. This is a prepaid expense. This is an accrued revenue. And then these last two look like they're accrued expenses. So here we have an interest expense and interest payable. These two go together. And then we have a wage payable, which we add as part of the wage expense up here. So you can see all of these are adjusting journal entries. And if this was the trial balance, we now have our individual adjustments. And what we do is we just go across and add the debit or the credit. So here, this has a debit balance. We reduce it with a credit. So now it's 1,000. And you notice some of them have adjustments and some don't. So if they don't have an adjustment, we just carried it across to the adjusted trial balance. Here, unearned service revenue, it is a credit balance and we debit it. So in other words, reduce it. So now it is 800 as a credit. You know, you can think of it as a T account. And so we bring all of this information here over into the adjusted trial balance. And remember, that's where we ended up in chapter 3. We have the adjusted trial balance, and we now have all of this information, and we can use this information in going to the financial statements. This particular worksheet has already done the work for us in that it has now split off the information into the income statement and the balance sheet. Now, obviously, there's one additional item. The drawings here end up going into the statement of owner's capital. So what we're going to do next is, now that we've looked at this great big worksheet and all the numbers have been prepared for us, now we're going to take these numbers and we're going to create the financial statements. So let's take a look at doing that. Okay, we have now our worksheet on the left, and we're going to go ahead and create the financial statements here on the right. And our information is broken up from the adjusted trial balance. The worksheet has already divided up the income statement items and the balance sheet items. We just have to make sure that we put them all in the right order. So here we can go and see that the total service revenue is $10,600. And I'm going to put this in an outer column because the inner column is typically reserved for subtotals. So we've got a bunch of expenses, and we're going to list the expenses in this case from the biggest to the smallest. So we have a salaries expense. We have a supplies expense. And you notice some of these are from the normal journal entries or from the original trial balance, and some of these are adjusting journal entries, but they all go together. Once we have all the information, we put them all in their proper place, the income statement or the balance sheet. So continuing on, we have a rent expense, an insurance expense, an interest expense where we're having to pay interest on a loan, depreciation expense, and I'm going to put an underline, and that subtotal will go over here. These will be the total expenses. Now I have total revenues, total expenses. I will put an underline under this, and I will basically take, this is the positive, right? This is the money coming in. This is the money going out, all the expenses. And so my net income is going to be 2860. And because this is the last bit of information on this income statement, we double underline. Now, the reason why we do the income statement first is because we need this number. When we go down to the owner's equity, which is the second one that we do, well, they didn't give us any particular information, so we understood that the owner's capital began at 0. We did an investment this point in time. If you look, that there's a $10,000 investment. So we increased our owner's capital, and then we're going to take this net income, because net income is basically profit, and the profit is owned by the owner. So we're going to increase this. Here I will do a subtotal, 12,860, and it'll be 0 plus 12,860 for a total of 12,860. I'm kind of mixing my items here up a little bit. Drawings are going to be, if we look at our information here, drawings is the amount that the owner withdrew from the capital, and it is 500. We can put it in parentheses, but we already have the word less, so accounting wise we know that's a minus, and so we're going to end up with 12,360. And this is the new owner's capital balance that we're going to use on the balance sheet. In other words, in order to come up with this number, we had to do the income statement first to be able to put in with the owner's equity, and so we calculated the owner's capital ending right here. So let's go ahead and take a look at the balance sheet. So the balance sheet, we have a bunch of different assets. So we've got cash here. We have accounts receivable. We have supplies. We have prepaid insurance. We have equipment. And because we have this little odd thing, the accumulated depreciation, this is basically a subtotal. So it's 5,000 less the amount of depreciation, which is going to be 4,960. And then my total assets are going to be adding up this whole column here. So it'll be 21,910. Now, remember, the whole bit about the balance sheet is that the assets must equal, remember, A equals L plus E. So when we come down to this one down here, total liabilities plus owner's equity, whatever this number ends up being has to be equal to 21,910. That's the balance sheet. It must balance. So let's take a look at some of the things we have here. We've got a bunch of liabilities. So we've got notes payable. We've got accounts payable. We have an interest payable. We have unearned revenue. and we have a salary and wage payable. We will subtotal those. I didn't actually need to put this underline here. And the subtotal will be 9,550. So we only have one thing in owner's equity, and that's the owner's capital. And what does it say for us over here on owner's capital? Doesn't it say 10,000? Owner's capital is 10,000. However, if we add 10,000 of this number, that'll be the liabilities plus equity. That won't equal 21,910. So why is that incorrect? Why are we not taking 10,000 off of the adjusted trial balance, off of the worksheet? The reason why, and don't worry, everyone gets this, muffs this the first time, is that didn't we just get through calculating the new owner's capital? Remember, the owner's capital on the worksheet is the beginning amount, and then we added the net income, we took away the drawings, and now the new owner's capital. So it just so happens that people get so used to transferring numbers from the worksheet over into the financial statements that they get down to owner's capital, and a lot of times they'll just put that number there, even when they know that they had just calculated a new number. Well, we need that new number. And having that new number then allows these two to add up to the proper number, 21,910. So if you get to this point and you get stuck and your balance sheet doesn't balance, 9 times out of 10, it's because you're not using the new owner's capital that you just calculated in the previous statement. So use that number and then things should work out. Okay, when we get to the next video, we'll go through the rest of the closing process.